difference between the factor income earned from abroad by normal residents of the country, say India, and factor income earned by non-resident in domestic territory of the country. That is, in GNP, only the value of goods and services of Indians are to be calculated. So likewise, I told in GDP that there would be some foreigners working in India, or foreign people doing business in India. Now their the value of the goods and services those foreigners are creating in India, that cannot be accounted in calculation of GNP, gross national income. So that how much Indian people from abroad they are sending in money into India, that has to be reduced. From that, the money or the monetary value of final goods and services the foreigners are producing in India, that has to be deducted. If you do that, we get net factor income from abroad. So GNP, it is GDP plus net factor income from abroad. Now all these formulas UPSC has not asked a question, but what we need to be clear is that GNP means it is the value of total goods and services produced by Indians within India and from abroad. Any other foreigners creating goods and services in India, that value, monetary value of that goods and services is not accounted. This we have to keep in mind. So next is net national product, NNP, at market price. So it is the market value of net output of final goods and services produced by an economy during an year, and net factor income from abroad. So this is from GNP, that is gross national product. If we reduce depreciation, we get NNP. So here what we have to know is that from GNP, that is gross national product, if we reduce depreciation, we get NNP. That's all we need to know for the exam point of view. Now another thing which we need to know is that depreciation. What is meant by depreciation? Now depreciation is the simply it represents how much of an asset's value has been used up. For example, you buy a new car, after few years it would have got wear and tears, some scratches, the engine performance will come down. So it is a depreciation. So that depreciation has to be reduced from GNP. If we reduce that depreciation, we get NNP. So depreciation means simply reducing the value of the wear and tear that has occurred over the years, that is depreciation. So NNP is GNP minus depreciation. Now national income, coming to national income, how national income in particular is calculated. National income at factor cost, that is factor cost, we saw market cost and factor cost, market price and factor cost. In earlier we saw here NNPs at market price. Now what is the difference between the market price and factor cost? Let me first explain this. So market price and factor cost. So factor cost means what is the value, monetary value of the product when that product is coming out of the factory. Let's take the factory is producing a pen, and the cost of production of that pen is 5 rupees. So that when the what is the value of that pen when it comes out of the factory, that is the price at factor cost. And market price means this 5 rupee pen which comes out of the factory, when it reaches the market, there are a lot of other stakeholders involved. Example, there is logistic cost, transportation cost, then there is wholesaler, then wholesaler will sell to retailer, distribution, all this happens, and by the time it reaches the market, the value of the pen would have become 10 rupees. So the value of the pen let's take the value of the pen at market price means it is 10 rupees. Value of the pen at factor cost means it is 5 rupees. This is the difference between market price and factor cost. Factor cost is the value of the product when it comes out of the factory. So national income or national income at factor cost is total income earned by resources of their contribution of land, labor, capital and organizational ability. Hence, the sum of the income received by factors of production in the form of rent, wages, interest and profits is called national income. In simple words, it is NNP, that is net national product. What is net national product? GNP minus depreciation. So NNP plus subsidies. Subsidies is the government will give some subsidies to the factories, right? So that subsidies minus indirect taxes. Why indirect taxes has been reduced? Because if we add indirect taxes, we would get not at factor cost, rather at market price, because when the product from factory reaches the market, there would be indirect taxes would be added, right? So only if you reduce those indirect taxes, we will get the national income at factor cost. So national income is NNP plus subsidies, that is the subsidies which the government give to the factories minus indirect taxes, we get national income. So here what you have to concentrate is what is the difference between factor cost and market price, and subsidy means it is the subsidy which the government gives to the factory, and indirect taxes means that is GST. These formulas you don't need to be worried, because UPSC has not asked questions specifically asking the formulas. Next is personal income. Personal income means it is the total money income received by the individual and household of a country from all possible resources before direct taxes, that is before they pay the taxes. That is, a person is working in a company or in government, before they will get a monthly income, that income before they pay the taxes, what is the income that they have, that is called as personal income. Now when that personal income, if we reduce the direct taxes, we get disposable income. So what is disposable income? Disposable income is actual money, how much it is there in your hand which you can spend, that money is called as disposable income. So disposable income is income left with the individual after the payment of direct taxes from personal income. It is actual income left for disposal, or that can be spent for consumption by individual. So disposable income is personal income minus direct taxes. Now what is meant by per capita income? Per capita income, we would have heard a lot that per capita income of India is less, or developing countries is less. On the other hand, if you see the per capita income of the developed countries, it is very high. So per capita income means national income when divided by the total national population, we get per capita income, that is totally the national income how much it is, and it has been divided. If the national income is divided equally among every citizen of India, then that how much it will come, that is called as per capita income. Per person how much is the income. Now obviously there are reasons to why India there is per capita income is less. One is population is high. So when the national income has to be, if it is divided by large number of population, the national income will per capita income will naturally will be less. On the other hand, if the population is less, the national the per capita income will be higher. So per capita income is simply national income divided by the total population. Now let's see the measurements of national income. How national income will be measured, through which and all methods national income can be measured. First is, it can be calculated by means of income method, then product or value added method, then expenditure method. Let's see income method. Now income method, in this national income is measured as flow of income. Here you count everyone's income, but some people may be running business in credit, so sometimes the payment may be delayed, so it may not give the full picture of the given year. However, this method emphasize on calculating the income of every person. Now let me explain this with an example. Let's take, you have bought a car. Let's take, you have bought a car. Now the cost of car, you have bought the car 5 years back. Okay, you bought that car for, let's take for simplicity purpose, rupees 1 lakh. Now you bought that car for rupees 1 lakh 5 years back. So when you bought that car, new car, the value of that car has been added to the GDP of that year. That is, let's take 5 years, 2015. So in 2015, the value of that car, that is 1 lakh, has been added to the GDP of that year. Now this year 2020, you are selling that car again. Now that car you are selling for, let's take for simplicity purpose, 50,000 rupees. Now whether this 50,000 rupees has to be taken into account for this year's GDP? No. Why? Because it is only once that value of that product can be added to GDP. It has been added in 2015 itself. So this year you are selling it again for 50,000. The value of that car cannot be again taken for calculation of GDP. However, there is a person, let's take, you are selling it through a the broker. You have to pay commission to the broker, right? So let's take, you paid rupees 1000 as commission to the broker. Now whether this 1000 has to be added to the this year's GDP? Yes, this 1000 has to be added, though the cost of the car you are not we are not taking to GDP of this year, but this service, this is the new service. This broker is selling this car for the first time, so this 1000 rupees has to be added in this year's GDP. So now let's take this 1000 rupees the broker is taking, and broker is using this 1000 rupees to pay his water bill. Let's take 1000 rupees is the water bill. So the water bill, he is paying, he is using this 1000 rupees to give it to the water company. Now when this water company with this 1000 has to be again added. So let's take for simplicity purpose, let's see that only this is the monetary transaction that is happening in the economy. So 1000 rupees that you have given to the broker as commission, that you have to add in calculation of GDP. Then that same 1000 rupee he has given to a water company as a water bill. So that is second time that money is changing hands. So again that 1000 rupees has to be added. Now let's take this 1000 rupee, he is giving it to the income of an employee in that company. He is giving the income 1000 rupees. Now this is also a new service, so this also has to be added in the GDP. So it is 1000 again has to be added. So total GDP of this year would be 3000 rupees. So by calculating the income, by income of the broker, that is commission, we added the income of the company, then the income of the person, employee who is working, let's take the clerk. So by calculating the income of the individuals, we are able to calculate the national income. So that is income method. Now again here it is the formula. You don't need to worry about the formula, because UPSC has not asked question based on formula. Now next is product or value added method. How national income can be calculated based on the product or the value added method is, let's take, it is the national income. In this, national income is measured as a flow of goods and services. The flow of goods and services, that is if wheat, you are producing wheat, then wheat you are making it to bread, then bread you are making it to cookies or something else. So like that, even there is a continuous value addition. So in each stage the value added, how much the value is added, that alone you keep on adding and you find the national income. So to be more clear, let's see this example. So total money of everything produced, value added at each stage is taken in here. Let's take a farmer produces wheat. So farmer produces wheat and sold 100 kg of it at 2000 rupees. Now flour mill purchases it, grinded it and sold the flour to the baker. Now the flour mill is doing this work and he bought it for 2000 for 100 kg, he bought it for 2000, he grinded it, he did all this and then he is selling it to baker at 2500. Now here 500 rupees is the value added. Now the baker is making it as bread or cookies or biscuits and then he is again adding the value, no, and again he is selling to the customer 3500. Now 1000 rupees is the value added. Now what is the GDP? Now when we calculate the national income, what we have to calculate, whether it is the 2000 that the farmer got, then 2500 at which the flour mill sell to the baker, and then 3500 at which the baker sell, totally 8000. No, it is not that. It is the total money value of this is 2000. What is the 2000? That the farmer sold the 100 kg for 2000. That 2000 we have to account because it is the starting. Then how much the baker is adding the value to it? Only 500 rupees he is adding the value to it. So that 500 you have to take, and then sorry, here flour mill, how much the flour mill is adding the value? 500, that 500 you have to take. Then baker, how much he is adding the value? It is 1000 rupees he is adding the value, so 1000 rupees you have to add. So national income here through value added method, if you go, we get 3500 rupees. So this is value addition method or product added method for calculation of national income. Now next is expenditure method. So expenditure method, in this national income is measured as a flow of expenditure. So how much is the expenditure? Expenditure of whom? Of everyone, that is government expenditure, individual consumption and investment, and the difference in export and imports, all this is added, we get national income through expenditure method. That is the expenditure of different stakeholders, that is government, individual and the investor, and the difference in import and export, if we add, we get national income through expenditure method. So that is all in national income. So the in this chapter, what you have to, as I have mentioned in the beginning, what you have to concentrate is the basics, that domestic territory, then the citizen GNP, and GNP means the monetary value of the goods and services produced by the citizen throughout the world, not only in that domestic territory, but even if it is he is abroad also. So like this, and what is the difference between market cost, market price and factor cost, then the value addition, what is meant by value addition, whether value addition method can be used if in calculation of national income. Like this basic concept you have to be clear, and you will be able to answer the UPSC questions. So thank you, have a nice day.